right. Let's take it to Nilesh Shah now. He's Managing Director and CEO at Envision Capital. Nilesh, good morning. Great to have you with us here on the program. Thank you very much. So we are still kind of in the phase of finding out what will happen. And I'm not sure if we will remain in that state for some time to come, a state of expectation and not knowing. So a headline watch in that sense. But for bottom-up investors, I mean, it's I guess any other day with some entertainment added for people like you, Nilesh, in that sense. Your thoughts as you look at this new phase in markets. Maybe I'm exaggerating it with Trump 2.0, but your thoughts? Nilesh, you'll have to unmute yourself, please.
Yeah. Hi, Prashant. Sorry for that. I guess it's one more year, one more day, and one more event. Eventually, like what you rightly said, a fundamental bottom-up approach always holds you in good stead, and I think that kind of an approach even remains even now. Yes, 2025, we are going to have a bit more of macro headwinds, global macro headwinds. There is a new presidency in the United States, and policy initiatives, especially on the tariff side, will have significant implications. But having said that, I believe what's going to be even more important is what the central bankers do in terms of interest rates. I believe interest rates will be a bigger trigger and a bigger catalyst to watch out for in 2025. And that, to me, remains the biggest kind of variable as far as markets are concerned. So clearly, from a global macro perspective, I clearly believe that what the central bankers will do in 25 will be way more important than what the new presidency does in terms of policy initiatives.
Okay, Nilesh, hi. Good to have you on the show. So I think markets are just trying to figure out what this means. We spoke to a couple of international experts, and I think the view seems to be that for the US equity market, at least the party is intact. Now that boils us down to here, what we're doing at home. So what's the sense? I mean, the immigration policies will become clearer, I think, in the coming few weeks. But as we await that, let's talk tech and what you've seen and heard from the companies so far. What would your view be? Would you buy large cap or niche mid cap? I mean, how would you look at taking exposure given all the uncertainties at hand?
Surabhi, I believe that, this whole issue around immigration is probably just overly debated. And I think the impact of that is a little exaggerated. The Indian IT has moved on, and as there is more automation, more around robotics, I think the growth potential is not going to be really a function of more the kind of hiring or the kind of more people that you can send on an on-site basis. So I believe that the whole challenge or the issue around immigration is probably a bit overestimated. I honestly don't think it's going to move the needle. What's I think we need to realize is that for the large cap IT, it's going to be essentially the US GDP growth rate and the spending on technology. Even if we look at the last decade, which has been clearly a landmark decade in terms of adoption of technology, digitization, our Indian IT companies have at best grown at 10% in rupee terms. You strip out the 3% of depreciation of the rupee. In dollar terms, the growth is 6-7%. And that's essentially what is the sustainable growth rate. So my view is that for growth investors, the large cap IT space doesn't make sense unless you are a benchmark driven investor. And there are plenty of opportunities in the tier 2 IT space, companies which are essentially going to be AI developers or going to create solutions around AI for global companies. Those are the kind of companies which will probably kind of be the better place to be. They are going to be the growth frontiers.
Nilesh, I remember when we've spoken about playing the new side of technology in the past. I remember our conversations. You've been fairly optimistic on some of the platform plays as well, right? I mean, it's consumer tech. And now we're in the midst of a very interesting debate. I mean, Zomato's triggered that debate yesterday by saying that as they invest more in growth and they accelerate their store rollout plan, there's also intense competition, which is why their margin expansion, at least in quick commerce, is on a temporary pause. What do you make of this? I mean, there's pretty dramatic reactions playing out on the stock even this morning. Not just Zomato, I'm just saying general, quick commerce and consumer tech.
Yes, Surabhi, we own a bunch of these platform companies.
Yeah.
We really have been in this space now for a while, and we continue to like it. We clearly believe that these are going to remain the wealth creators and the winners for a very, very long period of time. In between, there could be challenges for a quarter or two as companies essentially either accelerate or tweak their growth strategies. There will be competitive intensity, and in some of the cases, maybe some of the growth strategies may not work for a short while. We've seen, for example, like what the Zomato management itself has said, and we own the stock, itself said that look, they saw a similar thing playing out in the case of food delivery, where they went in aggressively and then had to pull back later. It's quite possible that quick commerce will also witness a similar situation. So it's honestly not going to be for the faint-hearted or for the more short-term oriented investors. So if you're looking at the next 1 or 2 quarters or maybe 4 quarters, it may not be the right place to be. But if you have a 3-year, 5-year, or 10-year view on this whole digitization opportunity, we have to use these weaknesses to essentially continue to buy and load up on the space. So I would still continue to be a long-term believer on some of these companies.
Okay, a very valid point there, Nilesh. For the longer term, they still have plenty of headway over there. But otherwise, in the near term, they could have some challenges. Got that in terms of these players. But Nilesh, let's talk about another set of stocks that the street has been very excited about. The EMS plays, so much of potential, big runway for them, but valuations are something that's worrying. Dixon Technologies today, very, very good numbers, much better than what the street was working with. But the stock is down 6%, telling you clearly that these valuations now are weighing on some of these names. Your take on the space?
EMS continues to be high potential, but clearly believe that at these kind of valuation, the valuations don't make sense around this time. When stocks are trading at whatever 120, 150 times trailing earnings, the reality is that these are B2B businesses at some point of time. Clearly, the growth outlook will catch up. These are businesses which will not keep growing at very, very high rates. We've seen this kind of movie really play out, 20 years ago when it was IT services, or maybe a few years ago, we had the chemical companies. We had so many companies coming out in the chemical space with IPOs, and we saw clearly that after a few quarters, growth didn't sustain, and therefore valuations essentially moderated. The stock prices didn't go anywhere. It's quite possible that the EMS space will face similar challenges at some point of time. Hard to really take a call when that will happen, but these valuations, I don't think they really make sense.
Okay, so valuations are a concern. Got that. By the way, just a quick glance back on the screen, and it's still the same picture. The bank nifty is slightly lower, flat line with a bit of a negative bias. The mid-cap index is also absolutely at the flat line. The nifty is retaining a bulk of its gain. It's the best performing index right now with an up move of about 60 to 70 odd points. That's the market picture. Nilesh, so there's so many uncertain moving parts. There is Trump and tariffs and policies. There is the earnings slowdown here in India. Everybody agrees that earnings downgrades will happen even for FY26. There is this trying to second guess what the Fed and the RBI will do. In the midst of all of this, let's talk buying ideas. So you've mentioned your views on IT and, of course, the platform companies. What else? What else to buy in this uncertain time?
So clearly, we saw last year that there was a bit of a kind of a slowdown for some of the capex kind of companies, companies which were essentially supplying equipment or components to the capital goods sector, or companies which were essentially part of the entire railway opportunity or the defense opportunity. And that was on the back of a slowdown in the government's expenditure. Clearly believe that is likely to resume in terms of the growth and the allocations. We'll get to know that on 1st of February in terms of the government's allocation for the new year. I clearly believe that opportunities around railways, around defense, around renewable energy, and companies which provide equipment and components or consumables to that space, clearly I think it's a good time to kind of start looking at them. In many cases, the valuations have come off, P multiples have come off. It might just be an interesting space to watch out for. So clearly believe that I wouldn't be surprised if by the end of this year, they end up being essentially the winners.
All right. Nilesh, I wanted to ask you about these gold jewelry themes. In the last 1 year, if I look at it, Kalyan was the one that zoomed ahead, and Titan actually was the underperformer. But now, the last couple of weeks or so, we have got back to hearing that Titan is equal to trust, and that's the only one that's done well in the jewelry space. And for a longer term investor, Titan does well. Keep in mind, it doesn't trade cheap at all. But at least, if I pull up a couple of charts, last 1 year chart, if I pull up a last 1 month chart, it appears, again, Titan could be finding, its way. Because in the past, you've seen PC Jewelers, Gitanjali, Tara, and the list goes on. But only this one has actually stood out and made some money. Your take on this space and the themes?
The space it continues to be very interesting. I clearly believe that the opportunity around premiumization, the opportunity around aspiring middle class, these are long-term themes. And so clearly believe that the tier 2 jewelry companies essentially are a good place to be. This is a space which has corrected. Obviously, for the year 24, this was a space which did extremely well in terms of stock prices. So clearly believe that, yes, there is some bit of correction, there has been a fair bit of correction which has happened. Maybe there's some bit of correction to happen as there's some pressure on the mid and the small cap space. But my sense is post maybe, the March quarter, post the June quarter, these will again kind of come out as meaningful long-term opportunities. So clearly believe there's lots of room to grow. The big difference between, what happened maybe a few years ago with some of the emerging jewelry companies, I think their big challenges were around cash flows. These were some of the companies which had huge amount of debt. They didn't have the cash flows. But the bunch of tier 2 companies that we are seeing in the jewelry space, these are companies which essentially have a calibrated growth strategy. They don't have too much of debt. Maybe some of them don't even have debt. They have been able to successfully raise capital and capitalize with themselves. So they have the growth capital to grow. And I think that's the big differentiator. Some of them, their franchisee strategy is working out to kind of do well in early days, but it's working out well. So overall, in terms of the space, the strategy, and the balance sheet, I think are very, very different from some of the earlier emerging names that we had seen a few years ago. So I would be constructive on this space.
Okay, all right. And Nilesh, got that. Thanks a lot for joining in. Always good to hear your thoughts and looking forward to chatting up with you in the coming weeks as well.